Hello, I'm David Cassidy with the weekly market summary for the week ending Friday, the 11th of September. All in all, it was a pretty positive week for equity markets, despite all the negative news headlines. As you can see from the accompanying table, the UK's FTSE 100 index ended the week just over 233 points higher. That is a gain of 4%. Helping this strong upward move was the weakening pound. Given around two-thirds of the FTSE 100's total revenue is derived from abroad, a weaker pound benefits exporters and those constituents with large overseas earnings. The notable exception to the advances last week were the US equity markets. As we explained in our last update, it's been their heavy-weighted technology stocks such as Apple, Alphabet and Amazon that have pulled the US indices lower. However, we don't believe there is anything sinister in this downward move. It is simply profit-taking, similar to wiping the frothy head from a pint of lager following the recent strong upward trend. The week's moves all do clearly highlight the benefits of diversification, as equity markets don't always move in tandem, and while painful, falls such as these are normal and should be expected, as unfortunately equity markets do not prove to be a one-way street. The week's most important economic data releases came last Thursday, the 10th of September. The weekly US jobless claims data showed that the number of Americans who filed initial claims was roughly the same as the previous week at 884,000, while continuing claims, which are the total number of Americans on unemployment benefits, increased slightly to 13.38 million from 13.29 million. The decline in jobless claims has been slowing of late, which underscores our argument that more US stimulus will be forthcoming. We just need the politicians in Washington from both sides of the aisle to stop playing brinkmanship at the expense of hard-hit American workers and agree a new US fiscal stimulus package. However, the week's US jobless claims data was overshadowed by the European Central Bank's, the ECB, the monetary policy meeting. In terms of tangible policy decisions, the ECB meeting was, as expected, a damn squib, as the ECB left both interest rates and the size of its quantitative QE, quantitative easing programme, unchanged. However, again, as we previously highlighted in these market updates, the euro has strengthened to the extent that it could start to create a risk to the eurozone's already anemic inflation and become a headwind for their economic recovery, especially given the recent resurgence in coronavirus cases. Consequently, it was comments from the ECB President Christine Lagarde that were our main focus. Although we didn't expect the ECB to directly act to weaken the euro, we did nevertheless expect Christine Lagarde to talk tough in order to limit the euro's strength. Consequently, we were completely taken aback by her lack of pushback regarding the euro's strength, commenting that there was no need to overreact to the euro's strength. And as a result, we saw the euro strengthen. Given the ECB didn't indicate there was any urgency to adjust the policy, the ECB has forming hesitancy. Our attention now moves to the week ahead as the Fed, the Bank of England and the Bank of Japan all have meetings to discuss monetary policy, as central bank policy has become a main driver of global equity markets since the global financial crisis in 2008-2009, and even more so since the coronavirus outbreak. In addition, we have from the UK employment data, unemployment rate and average earnings, CPI inflation and retail sales, whilst from the US we have Empire State Manufacturing Index Survey, University of Michigan Consumer Sentiment Index and the US retail sales.